Okay, time now for Hot Picks, where we ask an investing professional their highest conviction ideas. Today, we're focused on beauty and luxury. It's an interesting time to focus on the consumer. On one hand, concerns of a slowdown. On the other hand, a massive reopening in China that could certainly spur demand for a lot of companies that have put stakes in the ground there. Let's bring in Oliver Chen. He's senior research analyst at Cowen. Oliver, thanks so much for being with us. Before we get into your top picks in the sector, can you just talk about how you're thinking about that tension on the bearish side, weaker consumer perhaps in North America, on the bullish side, pent-up demand coming from Asia?
Amber, great being here. You're 100% right. There's bifurcation happening. So a big concern in the US is inflation, which is running at 6 to 8% or more, and the stock market performance. However, the labor market's tight. Unemployment is only 3.5%, and there's wage growth as well. Pressure at the middle and low end is quite obvious, especially with rising gas prices and other expenses such as food. Also, consumers are going out and traveling again. But what we see is a big opportunity in luxury goods, which have a lot of price leverage. Specifically, our top ideas include Canada Goose as well as LVMH. LVMH is a gigantic company. It's the biggest market cap company in Europe. So it has $7 billion of marketing spend and powerhouse brands such as Louis Vuitton and Dior. And Amber, you do get beauty too through Sephora, which is about 20% of the business. So beauty, wellness, skinification of hair, cosmetics, investing in your face, those are all important aspects for the new consumer. At Canada Goose, we're excited about the brand equity and innovation as well. And both of these ideas have big China reopening opportunities as well.
Okay, so we're looking at a chart of LVMH. It has run up. It's actually basically close to your price target. Is this something you're going to be looking to revise and revise higher as, it trades in Europe, and so Europe generally has been outperforming. Is there much room to go higher on this story on LVMH?
Yeah, we're excited about the long-term growth prospects ahead. They'll report this week, so it's something we'll monitor. Also, all the commentary on China will be very interesting and highly relevant in terms of the pace of the reopening, what happens in the future with Chinese traveling abroad and restoring a lot of the sales productivity that was completely lost. And also, on a week-to-week basis, how store traffic can resume in mainland. But the luxury industry just stepping back is a very concentrated industry where top brands occupy a big percentage of total. So Vuitton, Dior, those are brands that really fuel this engine of LVMH. And in tougher times, ironically, customers will go to top brands, Chanel, LV, Hermes. When it's a tougher time, you really understand the aftermarket value of these brands as well. So those are all factors. And LVMH is somewhat of a defensive opportunity as well as offensive, given the global growth opportunity in luxury goods.
Let's talk Canada Goose, because LVMH is a chart that goes up and to the right. Canada Goose is down and to the left, though it's popped recently in January. What has kept the stock a bit of a laggard off of its highs? And how much more materially do you think it can re-rate higher?
Yeah, Amber, what we're watching is this reopening. So China's been difficult for this company with store traffic and closures and encouraging consumers to be home in the name of safety. That's one factor. Also, on an ongoing basis, retailers need to manage inventory relative to sales trends and make sure they're on target. But what we like about Canada Goose is the valuation. So on an EV to EBITDA basis, it's at 10 times. Luxury companies can trade at 20 times or more in terms of valuation. That's very attractive. Second, the vertical integration, the capabilities Canada Goose has in Canada, and that's a very powerful asset for the long term. Third, product innovation, brand equity. They manage the product and the pipeline very tightly, which is very good for not having too much inventory and not discounting in the marketplace. And fourth, this brand stands for warmth. It stands for Canada, outdoor. We think that's defensible over the long term as well.
Oh, let's go to your third pick, because it's not a household name, though I see it pop up on my Instagram all the time, which I think speaks to how connected it is to social media. This is Revolve Group. And it has had a brutal year as well in terms of stock performance. What's the thesis here, and why has it underperformed so much?
Yeah, Amber, you're 100% right on Instagram it popping up because Revolve is the premier digital Generation Z online retailer, direct to consumer, an extremely engaged customer, aspirational. It's all digital. So, but this company does over 200 events a year, which really drive great content for Instagram. And as you know, it's a new generation Instagram, TikTok, Be Real, rethinking how consumers shop. Revolve's been at the center of this. One problem they've had is having too much inventory relative to sales. So it's something they're working through. We have confidence, and we also love this business model for the long term. It spends about 13% of marketing, 13 to 16% of marketing as a percentage of sales, which really helps fuel. They're also very fast, test, read, and react. Artificial intelligence is a big topic for us using AI with merchants. I teach at Columbia University a class called Magic and Logic. What you really need to do is link a supply chain up to fashion, and fashion is ever changing. So it's something we're watching. It's a growth stock, with the rising interest rate environment and what's been happening. Valuations have definitely suffered. And the consumer in the US has been very confusing because, on the one hand, the consumer is going out again, but they're also spending on travel. It's taking some money away from goods and services, and they have to pay for gas and food. So there's been rapid changes in the consumer and how the consumer spends as well.